Welcome. If you're looking to get smart fast, you're in the right place.
Absolutely.
Today, we're doing a deep dive into something that's really shaking up the financial world: artificial intelligence.
Yeah, AI in financial markets, it's moving incredibly quickly.
So, our mission here is simple: cut through the noise, figure out how AI is actually being used. Real time analysis, risk, trading, the whole picture.
Exactly. We've got key questions to guide us, really unpack the essentials for you.
Great. So let's jump right in. First big question: how are these AI algorithms actually making sense of the flood of market data we see every second?
Well, the key things are really speed and scale. It's unlike anything humans can do.
How so?
Think about it. AI can ingest and process massive amounts of data, news wires, trading volumes, economic reports, social media feeds all at once.
Okay.
And it does this in milliseconds, spotting patterns or correlations that a human analyst might take days to find, if ever.
So, like picking up subtle signals?
Precisely. Maybe a slight change in language tone in an earnings call transcript that hints at future trouble weeks before anyone else notices. That kind of thing.
Right, that makes sense. So, with that kind of analytical power, does this mean AI can just consistently beat human traders?
Sure.
Is AI the stock market guru now?
That's a really complex one. Yes, AI is brilliant at finding probabilities based on past data and current signals,
Ah.
but markets are fundamentally unpredictable. Human psychology, unexpected global events, these things throw curveballs. So consistent outperformance, still a huge challenge.
Okay.
That said, the fact that so many AI-powered trading platforms exist now, well, it clearly shows the direction things are heading.
Yeah.
AI is definitely a major player in trade execution.
Right, it's a tool, maybe not a magic wand. Okay, but what about areas like security? Fraud detection seems like a perfect fit for AI.
It really is. AI's core strength is pattern recognition.
How does that help catch fraudsters?
Well, it learns what normal financial activity looks like by analyzing millions, even billions of transactions. So when something deviates from that norm,
Mhm.
an unusual transaction size, a weird location, an odd sequence of actions, the AI flags it instantly.
Like an early warning system.
Exactly. A very powerful one. It adds a significant layer of security.
Makes perfect sense. Now, I've heard a lot about sentiment analysis. What is that exactly, and how is AI involved?
Think of it as AI trying to gauge the market's mood.
The mood.
Yeah, the overall feeling. Is the market generally optimistic or pessimistic about a certain stock or maybe the economy as a whole? AI tools scan text news articles, social media posts, analyst reports,
Hmm.
and they analyze the language used to measure that sentiment. Is it positive, negative, neutral?
And traders use this information?
Absolutely. If an AI detects a sudden nosedive in positive sentiment around a stock, for example, that might feed into a decision to reduce exposure. It quantifies the vibe.
Interesting. Quantifying the vibe. But okay, relying so heavily on algorithms, especially for super fast, high frequency trading,
Right.
are there downsides? Risks?
Oh, definitely. Speed itself can be a risk.
How so?
If many different AI algorithms are programmed with similar logic, they might all react to the same market trigger in the exact same way, at the exact same millisecond.
Ah, causing a cascade.
Precisely. It can amplify volatility enormously. You can get those flash crashes where prices plummet or surge incredibly fast before anyone really understands why. That's a potential systemic risk we need to watch.
Yeah, that sounds worrying. Okay, shifting gears slightly, what about something more fundamental, like deciding who gets a loan? How's AI changing credit risk assessment?
It's allowing for a much broader analysis. Traditional methods look at credit score, income, debt. Fairly standard stuff.
Yeah.
AI can look at those, but also potentially hundreds or thousands of other data points, things like spending habits, utility payment history, maybe even online behavior, though that raises privacy questions.
So it builds a more detailed picture.
A more nuanced profile of creditworthiness, exactly.
Mhm.
The hope is it leads to more accurate risk assessment and potentially opens up credit to people overlooked by traditional models.
Okay, now, the really big one: prediction. Can AI actually predict major economic events? Like, are we close to an AI forecasting the next recession or market crash?
The crystal ball question. Look, AI is incredibly powerful at analyzing historical economic data and finding correlations that might signal trouble ahead.
But it can't actually predict it.
Predicting complex systems like economies with certainty is, well, probably impossible. There are just too many variables, too many unpredictable human factors, geopolitical shocks.
So probabilities, not prophecies.
Exactly. AI can give us better probabilistic forecasts, identify heightened risk periods, model scenarios, but a definitive, the market will crash on Tuesday. No, we're not there, and might never be.
Understood. So with AI becoming so woven into the fabric of finance, what are the regulators thinking? What's the focus on the regulatory side?
They're definitely paying close attention. It's an evolving landscape. Key concerns are things like transparency, understanding how these complex AI models make decisions, especially black box ones.
Right. Avoiding bias too, I imagine.
Yes, ensuring fairness and avoiding algorithmic bias is crucial. And then there's the overall market stability aspect we touched on with high-frequency trading. Regulators want to prevent AI from inadvertently destabilizing things.
Makes sense. So finally, bringing it down to the individual investor or portfolio manager, how is AI changing investment strategies and managing money day to day?
It's leading to much more data-driven and potentially personalized approaches.
How so?
AI can sift through vast amounts of market data, research reports, financial statements to identify potential investment opportunities humans might miss.
Okay.
It can help construct portfolios optimized for specific goals and risk tolerances, and even automate rebalancing or tax loss harvesting. Think robo-advisors, but becoming increasingly sophisticated.
So more tailored strategies based on data.
That's the direction. More automation, more personalization, driven by data analysis at a scale previously unimaginable.
Wow. Okay, so wrapping up, it's clear AI is already having a huge impact across finance, from split-second analysis and trading.
To fraud detection, risk assessment, even how investment portfolios are built and managed, it's touching almost everything.
It really is.
Which leaves us with a really interesting thought to consider, doesn't it? As AI gets even smarter, even more integrated into finance, what does that mean long-term for the role of human experts? And, perhaps more critically, what safeguards do we need to build now to ensure these powerful tools contribute to, rather than threaten, the stability of our global financial markets? Something to mull over.